All right, so we're going to change a little bit and talk about another method. So we talked about the allowance method in the last videos. This is the other side to the coin when it comes to that method. So if you don't choose allowance method, then you would choose this method, which is the direct write-off method. As its name implies, we're going to directly write it off rather than going through the steps of the I think, the I know, and the uh-oh. So what this does is it records the loss of uncollectible accounts receivables when it is determined to be uncollectible. So we don't have that period of I think I'm not going to get this, so therefore I'm going to go ahead and expense it. There is no I think period. We only write them off at the moment, or we only expense them at the moment we know we're not going to get them, or when it's time to write them off. So no attempt is made to estimate bad debt expense. I don't have to worry about any estimations. I do it as it happens. Now, companies must weigh at least 2 accounting concepts when considering the use of the direct write-off method, because this doesn't necessarily follow GAAP. Remember, GAAP tells us that we have to recognize expenses in the time period in which we use to generate the revenue. And if that doesn't happen, if we're not doing this based on in that time period, we're not following GAAP. So one of them is the matching principle that they have to look at. The matching principle requires expenses to be reported in the same accounting period as the sales to help produce. So again, if you're not doing it in the same period, you really can't use the direct write-off method. It doesn't make sense. It doesn't follow the principle. And then also the materiality constraint. If you're talking about something very small, you can get away with this. You can go ahead and directly write it off rather than going through the I think, the I know, and the uh-oh process. But the materiality constraint states that an amount can be ignored when bad debt expense is very small in relation to the company's other financial statement items. So if you're talking about $50 out of $5 million, you can probably go ahead and just write it off because it's very immaterial. It's not going to change somebody else's decision when they see that. To kind of give you a better look at the difference between the allowance method and the direct write-off method. So here's a chart. That's obviously the direct write-off method is a little off, but we have our 3 steps. We have the I think. Again, the allowance method, the I think, is bad debt expense and the allowance for doubtful accounts. That's what makes the allowance method what it is. In the direct write-off method, it's nothing. We don't have the I think because we don't care about the I think. We don't write it off until we know. So there is no I think. Then you have the I know. The I know for the allowance method, we know this as ADA and AR. For the direct write-off method, we don't have an ADA, so we're just going to go ahead and put it into the expense account. So bad debt expense and then AR. And then the uh-oh is going to follow the same thing. We're going to flip it to begin with and then take it out of cash. Same thing with direct write-off method, except when we flip it, we're going to keep the bad debt expense. So it's going to be AR, bad debt expense, and then cash and AR. So that's the biggest difference between the two. Most of the time, you're going to be using the allowance method because, again, that does follow GAAP. That follows the matching principle. So that's the difference between allowance and direct write-off method. In the next video, I'm going to show you how to do the direct write-off method using the same examples that we did with the allowance method. So.